Want to grow financially independent? Here's how you can. If you want to know the answer, make sure to watch this video until the end. Hello, future billionaires. Welcome to Stock Investing 101, the channel where you get stock inspiration, motivation, and knowledge to become the next future billionaire. In today's video, we bring you why you should hold AMC until it goes times 10. Without any further ado, let's dive in. The epic short squeeze rallies fueled by traders at Reddit's Wall Street Bets forum are unwinding based on Tuesday's trading operation. GameStop dropped by as much as 67% on Tuesday, contributing to Monday's 31% fall. The stock was down 85% from an all-time high of $483. GameStop grew by more than 2,000% in January, leading to huge losses for some hedge funds like Melvin Capital, which dropped by 53% a month. For the past 52 weeks, AMC's low share price has been $1.91. Just this week, however, the units rose and traded as high as $20.36 apiece. This increase is responsible for a flurry of speculation triggered by GameStop's short tightening. To understand why this is so, we need to think a little about where AMC has been in recent years. Consider the duration from 2017 to 2019. In this 3-year window, the company's sales rose from $5.08 billion to $5.47 billion. Its net profit was negative in 2 of these years, $487.2 million in 2017 and $149.1 million in 2019. Its profit in 2018 was a paltry $110.1 million. Clearly, AMC was not a high-quality company in this respect. But if you look at the cash flow, the picture looks a lot different. The operating cash flow of $537.4 million in 2017 rose to $579 million in 2019, but not to $523.2 million in 2018. Even so, it's promising to see these numbers in a limited range. EBITDA remained robust as well, but the findings were a little different. After rising from $822.5 million in 2017 to $929.2 million in 2018, it fell to $771.4 million in 2019. Volatility like this isn't meant to be all that shocking. However, by 2020, the picture has worsened considerably. The data for the fourth quarter has not yet been given, but revenue for the first 3 quarters of the year was just $1.08 billion. This compares to $4.02 billion a year ago at the same time. Net losses of $135.6 million in the 3 quarters of 2019 rose to $3.64 billion in the same period last year. Also, the operating cash flow has grown from $210.2 million to $771.6 million. Frankly, all of this is anticipated. Fears about the COVID-19 pandemic and the resulting social distance mean that AMC's business model grouping people in a movie room is as unhealthy and unsafe as you can find. Throughout the last year, the organization has been focusing on cost savings and engaged in some creative financial transactions to improve its fundamental situation. For example, on December 11, 2020, the firm entered into an agreement with Mudrick Capital Management, the holder of some of its second lien debt. The deal allowed AMC to convert the $100 million to over 21 million common shares at an effective price of $4.55 per unit. They then obtained $100 million in first connection debt from the company. This is due in 2026, but the terms are steep. Instead of the 10% interest rate per year or 12% PIK paid in kind that second lien debt had, this new debt has a 15% annual interest rate. Since then, management has issued additional shares. A fraction of $164.7 million was earned for $406 million. This meant a weighted average price of $2.47. Then they recently sold 63.3 million shares for an average of $304.8 million, or $4.82 apiece. This raises equity to $710.8 million from December to today. After that, the company exchanged $600 million in debt for 44,423,000 shares. This indicates an average unit price of $13.51. At that point, shareholder Wonder Entertainment America forfeited and saw the cancellation of 5.6 million of its Class B shares. Although $600 million in debt conversion is promising, this was offset by $411 million in additional debt provided by the company. This new debt has an average interest rate of 10.75% over the duration, and then 11.25%. By contrast, the debt that was converted had an annual rate of just 2.95%. Although this sounds bad, and it is because it will lead to more interest being accrued in the long run, the short-term repayment of cash interest payments is what management is playing here. Because of the time periods for which these various transactions were made, it's hard to know how much cash the organization has on its books at the moment. We know, however, that cash burns an average of $124 million per month in the fourth quarter. Taking the final cash balance of the third quarter and adding these equity increases to it, the firm's cash is estimated to be around $1.18 billion. This includes cash burns for the month of January, however, because if the fourth quarter pace had been matched this month, cash is now estimated to be close to $1.05 billion. Net debt then is estimated to be about $4.65 billion. According to the management, if they can continue to receive concessions from their landlords by 2021, and if their estimate for monthly cash burns for the year is correct, they should have more than enough cash available to get through the year. This is focused, however, on expectations that indicate the firm's rapid recovery. For the first and second halves, the organisation expects the respective occupancy rates at its theatres to be only 10% and 15% of their 2019 levels. This increases to 65% for the third quarter and 90% for the fourth quarter. This could be possible with the delivery of vaccines, but it's difficult to tell. At present, there is no doubt in my mind that AMC will very well have to issue more stock in the future to stay out of bankruptcy. Also, the cash on hand is slowly decreasing due to the operational needs of this company. But instead of speculating how these two factors could make the company worse, let's take the firm in the vacuum as it stands today. This is definitely the most generous example. It does, however, give us something to work with when we try to value the company. Assuming that AMC survives the current downturn without any more material dilution and returns to the 2019 cash flow and EBITDA rate, the stock at $8.63 per share is substantially overvalued. To come to this conclusion, I was trying to find a reasonable baseline to value the company with. At first, I tried looking at its multiple cash flow price or operation between 2017 and 2019. This figure decreased last year from 3.60 in 2017 to just 1.30 in 2019. That was despite a general increase in cash flow during this window. The issue with this study was that this already leveraged company has continued to become more leveraged over time. As net debt rose, share prices declined from $15.10 apiece at the end of 2017 to $7.24 by the end of 2019. To see that the valuation of the enterprise as a whole remains stable in relation to cash flows, we need to look at the enterprise value. Its operating cash flow over this window ranged from a low of 9.05 in 2019 to a peak of 11.48 in 2018. The more conventional EV/EBITDA approach offers us an even narrower range of goods that the company dealt in. In this window, the figure ranged from a low of 6.47 in 2018 to a high of 7.13 in 2017. Reading was 6.79 in 2019. By contrast, if we expect the best for the company and assume that its cash flow metrics will return to what they were in 2019 once the sector has stabilized, its EV today is $7.59 billion. This means the EV/EBITDA multiple of 9.84. With shares up to $11.29 apiece, which is where they are trading after hours as I write this, the EV of $8.63 billion is a multiple of $11.19, and at a 52-week peak of $20.36, an EV of $12.16 billion works out for a multiple of $15.76. They're all way too high. If, however, we presume a reasonable range of 6.50 to 7.50 based on a historical precedent, the company's stock could be between $2 and $3.98 per unit. Again, this implies that there is no further dilution, that there is no longer lasting problems for its business, and that current cash does not materially shift from my prediction for today. It's likely that at least one of these will further damage the company. The operation has spread to another stock preferred by the Reddit traders, AMC Entertainment. The movie theatre chain had dropped by 55% at intraday lows on Tuesday and was down 71% from its recent peak of $20.36. In reality, this adds to the short press effect. Right now, speculators, not buyers, are pushing AMC shares through the roof. In the short term, this speculation could make the price go somewhere. Could the shares double? Why not? Could it triple though? Maybe. However, in the absence of management being able to issue large volumes of stock at a very high price during this speculative frenzy, there is no doubt that the shares are at best 50% lower than where they are. More probable than not, the price should be lower since the additional dilution is likely and the cash burn will hurt the business going forward. If you'd like to stay up to date with the best and latest content about stocks and entrepreneurship, then make sure to subscribe to our channel and leave a like on this video. Did you find this video valuable, or do you want to add anything? Make sure to let us know in the comment section down below. We are posting a new video every day with the most undervalued stocks in the market right now.